I'm Karn. I'm a private banker, and I truly believe that private banking in India has a very, very integral role to play over the next couple of decades at least. We have an important role to play as private bankers, especially for the growth of India. And the reason I am a professional private banker today is because the opportunity size is immeasurable. And I feel like it has a big impact on how we kind of look at things going forward. My original aim in life was to be a professional golfer, but I quickly took a U-turn the moment I reached college. I was on the college team, and after I saw the way the guys were playing there against me, it gave me a bit of a reality check. So I did a small U-turn, and I started focusing on academia a lot more than I did back in school for sure. And it was a bit of a crash course. The 4 years spent in the UK studying was a crash course in life, and things got really serious real quick. And I think I really got into the whole equity markets there in the UK. And I realized that India is a much larger opportunity for me when I actually did the math. And I came back to India in 2014 and have been a private banker ever since. It's going to be 10 years now. I'm still young relatively from a private banking in India point of view. But it has been a long 10 years, and hopefully I can do this for another 30 at least.
You wanted to be a professional golfer, and now you're the superstar at our local Calcutta Golf Club. So,
Yeah, I mean, I don't know if that's a good thing or a bad thing, but to be fair, our local golf club also has turned out some rock star golfers. So I'll take that as a compliment.
yeah, man. Local golf hero, Manchester United fan, finance guy. I mean, where have you been? I think Akhil and I are like sort of, you've ticked all the boxes, whereas we are concerned.
Are you a United fan too?
Yeah, bro.
Look at the t-shirt.
In fact, Akhil and I got to know each other and we bonded over United.
I mean, to be fair, the last 5, 6 years, there's not much of a discussion to be had about United, right? So maybe that's the reason.
Maybe.
Yeah, it's a depressing conversation. Hopefully it's PTSD now.
It's on the upward trend.
Considering you're a private banker, you would look at the more longer term view, right? And the longer term view is we're doing fine, we'll be fine.
No, so to be fair, I grew up in an era. I was a season ticket holder at Old Trafford for 4 years, so I watched a whole bunch of games there.
We're so envious of you.
So we grew up in an era where we won on an average 1.5 trophies a year. So it's very similar to all the guys who started investing just after COVID when they were locked down at home. They only saw one way, right? So they believed that whatever they touch, they'll make money in. And then reality struck hard over the last 18 months.
Talk to me about it, bro. In Canada, the whole property thing has been going like that. So many realtors came in, so many real estate people came in, and they are thinking that, property goes only one way. But the things that only go one way are called bubbles, right? So you never know when it bursts, when it happens, what happens. So let's get deeper into that. But before that, let's roll it back to your experience in the UK. And let's roll it back to you go there. What do you do? What do you learn? You said you got a whole life lesson in 4 years.
So, I spent a large chunk of my school life traveling and playing a lot of golf tournaments, right? So I wasn't in school a lot, to be very honest. I missed a whole chunk of school. And my school had been pretty supportive as well. They kind of gave me a lot of leeway. They let me come to school an hour, 15 minutes after the gate shut. They gave me that letter. I mean, while they thought I would use it for practice, you take those things for granted and you end up sleeping a lot more. So, when you end up sleeping a lot more, you realize that all your friends who want to bunk. So I used to live just 500 meters from school. So all your friends that would want to bunk would land up in your room, And I had a relatively decent sized room. So you would wake up to like 15 people on either side. So it was a bit of a funny situation. And I have very lenient parents, or I won't say lenient parents. I kind of made them lenient. So at a point, they kind of gave up and they said, jo karna hai karo. You'll figure it out. So the full advantage of that was taken on by my brother, who's ironically in Canada now. He's in Toronto. Yeah. So I think Vishnu knows him well, but so he's in Toronto. So
Yeah, we were in the same batch.
oh yeah, really? I didn't know that you're in 40.
Yeah.
Wow, I'm learning new things today. So so that's great. So so because I kind of broke that ceiling in terms of what. Or rather, I blurred the gray area a little more with my parents. My brother took full advantage of that. And since he's a lot more peaceful looking, they actually took for granted that he won't do anything wrong. So he would be out till about 4 or 5 a.m. and no one would know he's out. Whereas with me, it was the other way around. So they kind of got tuned to that. And of course, the stuff you learn with your peers in that age, especially if you're in a good group of people who aren't really leading you down the wrong path, then you actually, you pick up the smarts a lot quicker. And I think La Martiniere overall has had a history of a lot of students basically being extremely street smart and savvy with the real world. I mean, we've been prepared for the real world more than anything else. And I think heading off to the UK was a step in the right direction. It brought structure, but it wasn't something that was really intimidating because what I had seen already, the kind of exposure I'd already had in life with my peer groups and my traveling and stuff like that, all the kids who actually ended up first year with me were way behind in their social development, so to speak. So I ended up becoming the home team there. It's like, when the Indian cricket team goes to play anywhere in the world, it's the home team, even though it's Australia or England or wherever. So I ended up becoming the leader of the pack in a notorious way, so to speak. Whereas where I wasn't the one who was instigating or creating the havoc, I just kind of facilitated it and let them kind of figure it out their own way. So it was a fun-filled 4 years. And very quickly you realize in the UK that the one advantage of the UK is that they have a lot of history, right? So history is a great teacher. I mean, history ends up repeating in the sense that if you have a long history, you know what's coming in a sense, right? You know that you've seen these cycles before. Whereas India is still a 75-year-old country, so to speak, in terms of being an independent nation, right? So while we are a democracy, we're still figuring it out. And I feel like having the European base or a European exposure gives you a lot of clarity of thought, and it really creates some kind of structure in your life where you know that what long term is all about, right? So in my profession, for example, when I deal with a large chunk of my investors, for them long term, while verbally would be a contract of 3 years, 5 years plus, it really isn't. I mean, every 3 months portfolios are checked. Like it's like a parent-teacher meeting going on. क्या हुआ ये quarter या ये semester दिखाओ जरा, So it doesn't work out like that because I think India or Indian investors still have a long way to go in understanding what behavioral requirements are needed to be long-term investors in the true sense. But all I can say is we're quickly getting there. And I've seen that with my peer group, the next generation, which I consider myself to be, once they came into into their respective businesses, the way they behave and the way they react is exponentially more mature than, what the previous generation kind of reacts to situations and circumstances. And a small anecdote on this, I guess perspective and context has a role to play here. Just to give you an example, imagine you're a 20-year-old guy at the end of World War II in Germany, 1945, right? Or you're a 20-year-old guy in the United States in 1945. Naturally, if you're in the United States as a 20-year-old guy in 1945, you have the ability to take risk because there's massive growth coming, right? And you haven't seen the worst of it. Whereas if you're a just about a 19, 20-year-old guy in Germany, you've seen like your entire previous and your entire generation get wrecked. So you have to be a lot more conservative in approach and very, very risk averse. So I guess India and the previous generation of investors in India are also on those lines. We've made a hard shift from a socialist to a capitalist nation. I think post our independence, the reimagination of India was largely socialist. I guess with the Russia link and the Yugoslavia link and everything, and plus the fact that the US would support Pakistan whole hog. So I guess our allies naturally became the communist, the socialist left in the form of Russia, which was the other superpower post World War, right? So naturally, when you grow up in a socialist environment, it's hard to take risk, because when you do take risk and you do reap the rewards, your business gets nationalized, right? If your business gets nationalized, it's a risk you don't want to run. So most people, if you see, so we call it license Raj. Most of the success stories from the 70s and 80s are the guys in the commodity sector, mostly in the commodity sector, where you needed a license to be able to be active in that segment, right? Whereas after liberalization of India, which is 91, we were 30 years into liberalized India. Obviously, the first decade had its own issues because it was very nascent. But if you see the kind of Indian companies that are actually dominating today, they are a product of liberalized India. So when you make it an even playing field, the best will always rise up. The cream will always rise up.
So, Karan, what you speak about, this whole attitude towards investing, is very reminiscent of the first chapter of the Psychology of Money, where they also say that, your whole attitude towards investing and your whole attitude is very, very dependent on the year you were born, the kind of circumstances you grew up in. So that's definitely going to have an effect. And I think what you're saying is spot on, in that our generation that is coming into investing in the markets right now is a lot more pro-investing than what was our parents' generation and things like that, who were always taught to be a lot more conservative. So you hear a lot of these stand-up comedians and things like that going that, the parents' thing is always put it in an FD, go safer, save money. So this saving and this conservativeness is a major thing that's been drilled into the heads of at least the generation that has preceded us. I don't know how much it's translated into the coming generation. However, before we get completely into this, I want to just touch back onto a little bit about you. So you say you went to play golf in the UK. You hear a lot of people playing golf in the US. I haven't really heard too much about playing golf in the UK. How does that work, and how did you go about doing that?
So my original plan was to go to the US. I had an unfortunate incident which actually woke me up. So this was 2008 April. I was on my way to Florida. I had gotten into a team in Florida, just outside Orlando. And April 2008, I had this massive car crash, which fractured my tailbone. So I was out for like 9-10 months. So that entire year kind of, that year before actually heading off to the UK was a crash course in sitting alone and just reflecting. And in hindsight, if you ask me, while it wasn't great what happened, it was quite a painful experience. But I guess in hindsight, that 1 year was something I needed in my life to kind of slow down from the pace I had, and just to reflect and to gather my thoughts and to figure out the next stage, So it took me a while. Actually, I was off golf for almost from 2008 till the end of 2009, till I ended up going to college.
Oh my God.
Yeah, so
It's a massive layoff.
Rehab was hard, and I was on a wheelchair for like 6 months. So I had that Professor Xavier experience, I'd say. The original plan was to go to the US. In fact, my entire my peer group that was playing a decent level of golf around me, they all did end up in the US, apart from maybe 2 or 3 of my friends who ended up in the UK. But the UK is a different kind of a golf scene. Like, the Europeans are very different to the Americans, especially the Britishers, right? They have a league system there, very similar to the football scene. So it's home and away, and it's a pretty high level of golf as well. As you can imagine, Some of the best golfers in the world come from the continent, right? So, and it's very different condition-wise as well. So you can't kind of, it's apples and oranges. The culture is very different. The history is very different. The way you kind of acclimatize and the way you walk out on the other side is very different, right? And for what I do for a living today in India, I feel like in hindsight, the UK turned out to be a much better bet because it gives you the best of both worlds. It gives you a 300-year-old experience in what equity investing is about. At the same time, it gives you also the new age stuff, which is a ripoff of Silicon Valley because risk-taking ability is very, very high there. Family offices are very well ingrained there.
There are so many words in the past, like 2 minutes. First word we need to break down is my work, right? So the my work, private banking. Let's remove the fog from the word private banking. What is it? And then we'll get to the investing, and then we will get to everything else. So what is private banking? What do you do exactly?
Our job is primarily to institutionalize family money. To break it down further, to create a structure, put a structure in place that forms the bedrock of what a family does with its surplus income. The income which is not going to get reinvested back into the business has to have a plan. So our job is to institutionalize the way that income is managed. While I'll say that our industry right now is very, very nascent and is largely transactional. When I say transactional, it's very push sales kind of an industry still. You need another half a generation to go through this cycle for the previous generation to show faith in it, in the outcome. Because the outcome is post-dated, right? Outcome isn't coming today. The outcome comes somewhere down the line. So it's very hard to sit and convince someone, although it's a bit of an oxymoron because it's very easy to sell someone a property in India saying 10 saal baad banega, and they're ready to shove 20 crores down that when it actually does nothing. End up fighting a court battle with the promoter and, all sorts. Right? But when it comes to equity investing, or rather investing as a basket, I'll drill down to asset classes later. But broadly, equity investing is looked at upon in a risky way because you're sharing in profits, right? The moment you share in profits, it's not linear. And the moment something is not linear and you're used to linear flows of income, right? So our job is primarily to create a distinction between income generation and wealth creation. Income generation is what you do, what you generate from what you do. Right? What you are subsequently being able to, create with that income that you generated is where we come in. So I personally look at it in a different way. I prefer creating a form of a constitution for a family, say, Touch and I or a large family, where we kind of first figure out what is the objective and, if you're investing X amount, how are we going to react to certain circumstances and outcomes, and the end objective, what is your end game? The first question I ask is, what is the end game? Why are you investing? What is the reason for this? And then you kind of reverse engineer it back to the best of your ability. Obviously, there are many moving parts in the process. Say someone says, I have 10 years. I want you to create a plan for me. And I want you to kind of, with as much risk protection, if you can generate a certain IRR, I'll be happy. Now, my job as a private banker is purely risk management. My sole and whole purpose is to protect downside, right? The objective of investing is to get the upside, which will automatically be the outcome if we do what we're supposed to do.
Let's break it down further. Let's not have people get lost. Okay, so I'll tell you my understanding and correct me if I'm wrong. Equity is a piece of a company. If my company were a cake, then equity would be a piece of that cake. The difference between a cake versus a company, that a company is always growing and a cake is limited to what has been baked. My cake by itself, my slice, will grow based on how large it is in the first place. When the cake expands, the larger my slice, the more I get to eat. Eating it up would be like conducting the transaction of me selling my equity and gaining all the profits or the losses or whatever. The meaning of the word downside is that my cake actually decreased in size, and by how much. Right? So downside would be how much money did I lose? That is downside. How much money did I gain would be the upside. But at the end of the day, what will really decide whether my cake will increase or not is the company that is underneath it. My piece of whatever I hold is not something that increases in value and decreases in value, not by itself, but based on the underlying company, right? So I'll ask you the meat question. The meat question is, you are managing risk. Risk means the probability of my company doing well, or the probability of my company doing absolutely horribly. What makes a good company?
From a pure definition point of view, what is a company and how does it grow, right? A company can only grow if it is able to grow its cash flows. There's nothing else. So, business school definition of the value of a company is its future discounted cash flows. It's never its future discounted revenue. It's never its future discounted EBITDA. It's never its future discounted profit after tax, PAT, what we call. It's always the discounted value of its cash flows, right? So, if a company is actually being able to generate cash flow and use that cash flow to grow future cash flow, the net result is that company will grow. The value of the company will grow. Because what you're paying for it today, let's take 100 as what the company is invested in their business, right? And say on that 100, they're able to generate 50% in the first year, right? Say 20% is the cost of operating, your entire cost of operation, right? You're paying salaries, you're maintaining factories and so on and so forth, right? You're left with 30. Now, what's critical is that what you do with that 30 is going to define whether your company grows or not. It's as simple as that. If you are able to allocate that 30 in a manner which increases your strength in your industry, reduces competition in the process, right? Then naturally you start, so broadly, let me break it down even further. There are two things to look at broadly when you're investing in a company. Does the company have pricing power? I'll define pricing power. And has it got the ability to gain market share? There are only two integral parts for growth. Pricing power. When I say pricing power, a lot of people misconstrue the definition of a monopoly, right? So I follow a definition of monopoly, which is clearly listed out in the book 0 to 1 by Peter Thiel, which I consider, a must read by anyone and everyone. Like, you should not ignore that book. The definition of a monopoly is simply that I should be able to charge a premium for my product or my service, right? And if I increase my price, I should not lose a single customer. In fact, I should gain customers, right? For me, if you're able to do that, because in an industry, only the first or the second guy will have the ability to do that, right? If you're number 3, 4, 5, the only way you're winning anything is if you're cutting prices, cutting costs and prices, right? You get into a price war. So any kind of a company which enters into a price war is a straight no-no. So that's pricing power. You should invest in a company that has the ability to charge a premium and still gain market share, right? Now, how do you get to those points? How do you get to that particular, that inflection point, so to speak, in the growth life of a company? If your product is differentiating from the end product itself, or from the distribution network itself, or from a service is being able to provide, which is significantly superior to anybody in and around, or it has a monopoly on their client database So we say the new oil is data, right? So I think if you're being able to create a pool of data and are able to break it down to your requirement and to create efficiency in the process, I think you're a winner. And like I said earlier, there can only be one guy finishing first in class. Similarly, there can only be one guy finishing first in the industry. And so I'll give you a Sir Mo Farah example. It's like if you try to compete with Mo Farah, the longer you run, the further away he'll be. Right? The longer, correct. So the longer you run, the further away he'll be. The only way you will catch him is on the way if he crosses, say, Victoria Memorial Park, and he sees some kids playing cricket and he feels like he wants to play along with them for a couple of overs. Grab the bat, hit some sixes, and he knows he has a huge lead. So when that happens, it's the equivalency of complacency. It's equivalent to being complacent. From that 30 that you generate after your cost, if you're not able to allocate that back in an efficient manner, it's the equivalent to Mo Farah playing cricket on the way to his marathon victory. When that happens, it's over. So purely when you're buying a piece of a company, two things you broadly want to look at is, are they able to charge a premium and still maintain market share? And are they able to increase their market share every time they increase their premium? These two broad aspects create monstrous company.
Reminding me a lot of what, say, for example, a Geo is doing right now, where they initially came in and they went, oh, here's free internet for everyone, here's free phone connections for everyone, and here you go, free this, free that, everything, and they built their whole entire consumer base, and then they started charging premiums for it. Like today, their phone plan is on the higher side of when you look at the phone plans that are available. Even their internet, for example, it's not the cheapest out there. So they're able to charge that premium because that they have the best coverage in India and they are going to give you reliable coverage. So I think that's alluding to somewhat to what the point you were trying to make.
It's the opposite. Because I was gonna bring up the example of Geo exactly. Geo went into a commodity market and Geo failed to actually upsell their product. Rather, they completely demolished the industry by giving such cheap internet and taking all the losses for themselves in order to gain market share. But despite gaining the market share, they were unable to exploit it later on and really price it much higher and get the profits in. What do you feel about such a company?
Reliance has not generated positive cash flows in a couple of decades. I mean, the reason is because my first point, they're not being able to charge a premium straight off the bat. They had to go into a price war to get to a point where they can then convert the market, right? So what happens is, I'll give you an example. Like when you're paying for a service and you're adequately satisfied with that service, right? If that guy asks you for more money, odds are you're going to get onto somebody else who's offering you the same rate, if not cheaper. You're not going to pay someone for something, you're not going to pay someone more money to do what you're already satisfied with. Right? There's no Veblen effect here. Right? So the Veblen effect, the concept is very simple. You feel like if you're paying a higher price for something, it's premium. Right? But since this is at such a mass volume retail level, premium doesn't come into play. Premium is not the game here. It's a pure play volume driven commodity. But on the flip side rather, they're actually doing a great service to the nation if you look at it, right? Because what they have done by providing this free internet and cheap internet and creating a low data, you have to be cognizant of the fact that we're 140 crore people, right? We're the most populous nation in the world. So to connect 140 crore people, the prerequisite are two things: cheap data and quick construction of roads. The United States was built on the back of roads. India is currently being built on the back of roads. And with roads comes tolls and your fast tags and all sorts. So working capital cycles get crushed. Right? Things reach faster. companies get more efficient because the infrastructure is supporting them now, right? So to be very cognizant of that. So what they have done is they've benefited the economy in a huge way. But from a shareholder point of view, I may not be very keen on holding a Reliance, to be very honest. I mean, if they show cash flow doing what they're doing, then it's a no-brainer. But as of right now, they're not showing cash flow. So it's always there on the lookout. So to give you a sense of companies that are showing cash flow and have the ability to, it's a well-spoken of example, but HDFC Bank, I think, would be a great story, or a Titan would be a great story, right? HDFC Bank was your first private bank to list back in the 92 or 93 or whenever it listed in 30 years ago. See, the shareholder value is created, and besides that, it's not even scratched the surface yet, right? It's 13% of India's lending market today, and the stock is up some 1000x since it's listed. So to give you a perspective on numbers, HDFC Bank just merged with its parent entity, HDFC Limited, which is the mortgage monster. After merging, it has a total valuation or market cap of $160 odd billion, $157 odd billion. HDFC, the merged entity, put together is about 8 or 9% of India's total profit after tax. Corporate India's total profit after tax, 1/10 of that comes from one company today, right? So now to put it into perspective, JP Morgan just gave a forecast for this year. They are predicting a net interest income. So just to break it down further, a bank's job is to lend money, but whose money are they lending? They're lending money they borrow, right? Whose money are they borrowing? The depositor's money. So current account, savings account, fixed deposits, all of these are forms for them to avail of the capital, the raw material. For the bank, it's a liability. So we call it the liability side of the book. And the asset side of the book is the lending that they do. So you as an individual, for the bank's asset side is your liability. But from a bank's point of view, they're putting their money to work, right? So they basically have a liability side and an asset side. The difference between the liability and asset is what the bank makes. How much they are able to raise at, what is their cost of borrowing, and how much they're able to lend at. The spread between the two is what the bank makes. In our language, it's basically called interest income, the net interest income between the cost of borrowing and the cost of lending, right? JP Morgan this year has projected a net interest income, the pure gap between how much they're borrowing at and how much they're lending at. JP Morgan has given a projection of $87 billion of net interest income for this financial year. To put that into context, HDFC Bank, HDFC, the combined entity, is $160 billion in valuation. So it's 2 times of what JP Morgan is going to make just this year. That's it. In interest only. JP Morgan's interest income is half of HDFC's total market cap. Yet in India, people believe that HDFC ab yahan se kya karega?
You know, it's very interesting. It's a very interesting concept.
Oh yeah, sure.
My understanding is that finance is kind of a cult. And I'll tell you how. I don't mean it in a negative manner. When more people view value in a particular kind of company, more people invest in that kind of company, right? The more people investing in a particular company starts inflating the company's value. Cool. So when you study finance, whether you study it in the US, in the UK, I don't know about the UK, but I'm assuming it's the same books. In India, in Canada, we are taught the same fundamentals about a good company, right? We are taught free cash flow over everything else, and we are taught all of this. Funnily enough, when I put a filter on or when I look at a stock screener and I'm trying to figure out some nice companies, I lean heavily towards financial companies. Because you would assume that the companies that are run by financial people go hand in hand with your thinking and they resonate with you, right? So that's why you talk about HDFC. I'll talk about that Gecko Insurance, or I'll talk about Bank of America, or I'll talk about Citibank, right? So it's very funny because our cult believes that that is how good companies are. It is stronger companies, heavy on the asset side. We know book value, they are strong. We know price to earnings, they are strong. Like price to earning on banks is like 2.4 on average right now in America. It's just crazy to think about because generally these numbers are at 7s and 8s and 9s, right? So you start thinking that's where value is driven. And I feel like each investor has their own mindset. So when you come out of engineering, right, you do not look at cash flow. When you come out of engineering, you believe value is driven by a product that will potentially just change the way we think. For example, Tesla. When you talk about Tesla, people believe, oh man, this company is going to make everything electric. And this company is going to set up electric grids all over the place so that we can all charge our cars, which they did. This company is going to hand electric vehicles in everybody's hand, which they did. Because the next generation that comes in and knows science and understands the importance of global warming wants to make an impact. Now all the car companies start flooding in with electrical vehicles, right? And because they are doing so, suddenly Tesla starts becoming more of a commodity. But the engineering community can see that this guy has a future vision, irrespective of the kind of cash he'll make. Same with Apple, right? When you see Apple, you're like, oh, it has a huge ecosystem. Irrespective of what kind of money they'll make, the community starts valuing them today. So a lot of people, similar mindsets, start putting their money into one place and suddenly the thing starts expanding. So our financial cult generally leans towards banks, insurances, fintech, financial. Fintech is kind of funny because everybody leans towards them because everybody gets like a little bit of all of it. What do you think about growth companies? The ones that don't do profits and the ones that don't play on this cash flow game. Just what is your opinion on it?
There are 500 ways to heaven. There's no one single way, right? So we just have to weigh what will be the Dravid in your portfolio and what will be the Sehwag in your portfolio. How many overs does Sehwag get to bat? And you say you put Sehwag out there on the first day of a test match, right? You tell him, boss, you have 30 overs, jo karna kar lo. Right? So that allocation is what you're talking about. So we are not shying away from anything. Our investment universe is very dynamic and nimble-footed, and we have to be at the forefront of change because if we are the foot soldiers of change. If I'm not going to be able to bring a concept of change to your table, then what am I doing? But while that is happening, I cannot forget the root, which isn't as exciting today. It is my job to manage risk at the end of the day, right? So if it's my job to manage risk at the end of the day, I have to be the most boring guy in your life. If I'm creating excitement in your life, then I'm not the guy for you. Right? If I'm creating excitement in your life, then I'm a pure transactor. The only interest I'm looking at is myself. Right? And then if that is the case, what I work on with you may or may not work for you. Will definitely work for me in that short term. So then you are a trade for me. You're not a portfolio stock. Similarly, these growth companies, while we use the word growth, but what is the metric we're judging the growth on? Last I heard a couple of years ago that someone got funded on the back of app download multiples. So I've heard all sorts of stories in the last 3 years. I think the last 5 years, a lot more has happened than what would have probably taken place for the last 20 years, especially in India. So I feel like everything has a space. You just have, so it's my job to identify how much space X or Y should have against your objective. I'm never against anything. like say a Nika kind of a company in India, right? I think it's a great company. I think they're doing a great job. In fact, they're profitable as well, right? They have been able to create value in a commoditized space, right? By in-house brands and by being able to take control of the influencer network and all sorts of things, right? So their supply side has been very strong. So you can create big winners in these growth companies, but your mortality will be very, very high, right? So you have to be ready with that. So the only way to think that through is that it cannot be a significant allocation of your overall portfolio, that if shit hits the fan, it just hits the fan in the toilet. It doesn't lead to the living room, right? Because if it leads to the living room, then it's a bit of a problem, right? So we have to limit how much of the surface area exists between the shit and the fan. And if it works out, there's a Himalaya in your toilet, like you build a mountain there. If I hold one stock in my portfolio that does 50x in the next 5 years, and say if it was 5% of my portfolio, right, that becomes a sizable chunk of my overall portfolio. So my risk concentrates hard. So it is my job to then bring it back to, or maybe keep it slightly higher than what we had originally discussed, if we believe that has a significant upside left in it. But we cannot let it become 80% of our overall allocation, right? Because that's not what we're doing this for. So coming back to risk, it's all risk management. End of the day, I'm sitting with the scissors, right? And the shampoo and the hairdryer. My job is just to keep on trimming every time something goes out of whack. And those are the hardest discussions to have, right? Because when the going is good, people forget about fundamental. For them, price to bhag rahe na. Someone is valuing it more. So then we come back to a concept called mimetic desire, basically mimests, which is a concept coined, I would say, by a gentleman called René Girard, who was the professor of philosophy at Stanford. He's Peter Thiel's guru, right? So the concept of mimetic desire is that this can only have value if you and I want this. If only I want it, no one's going to make it. So there has to have, for X to have value, someone else must also desire it, right? The greatest example is a Birkin bag, right? Whatever Hermes kills it on. Selling bags for 30 million, 5 million, 10 million. It's a bag, it's a handbag, right? How could it cost that much? So it's pure mimetic desire.
The greatest example is money. Because you and I believe that paper is worth anything and that IOU gives me a power over you, we have it. Tomorrow, Vishwat was talking to me yesterday and he was like, bro, if you go to a village in India and you hand them $50, they will not even know what to do with it. They'll be like, what is this nonsense? Isn't it? There is no inherent value to that green piece of paper unless we believe in it. One more thing I would like to discuss with you. I would like to discuss many more things, but one more thing that I would like to discuss with you would be our industry gets very complicated. We use very fancy words, right? A lot of these words most people don't understand. EBITDA, interest rates, all of these words, they're formed innately confusing. One other thing that is very confusing is the titles. Private banker, wealth manager, private equity, asset manager, portfolio management service, index fund, mutual fund. They inherently have a lot in common, but there are like 30,000 different words to define all of them. Let's break down some of the common ones. Let's break down a private banker, let's break down a wealth manager, and let's break down a portfolio management service and put in like a little bit of an index fund in there. Let's go.
Sure. So, in essence, private banker and wealth manager can be synonymously used, right? Because if I'm a private banker, what I'm trying to say is that I have a limited audience that I'm working for or working with, right? Because end of the day, I can only do so much, right? If I cross a certain client threshold, then I'm doing a disservice to existing and incoming. So I have to be cognizant of the fact that what my bandwidth allows me to give my full attention, because as I said, it's a dynamic industry, everything's changing. While our bedrock remains broadly the same for the next decade, I have a sense of what we're trying to achieve here, but we have to adapt, and to be able to adapt uniformly becomes difficult. So private banker and a wealth manager is synonymous to a large extent. A private banker would more be associated with a large institution, right? A reputed large institution like LGT is for me. It's one of the oldest private banks in the world. Where the job, the genesis of the company being formed was managing money, and it was only done on the back of the princely family of Liechtenstein being able to successfully manage their own wealth for the last 500, 600, 700 years, right? So it's an extension of the genesis of the family. And one advantage with LGT is that we're not a fund, we're not a private equity fund that's invested in India that has an exit in mind. Then it's not a ticking time bomb. And on the 5th or the 6th year, we need to find a buyer, right? The advantage of an LGT is that it's completely unlisted, wholly owned by the royal family, the princely family, and there's no pressure, or there's no, speed is not of any essence or importance. They've seen 1,000 years. I think 20 years of my life won't move the needle in the grand scheme of things. So broadly, a private banker is more of an institutionalized way of managing money, with a back end, with a support team, with a family office set up, with product pipeline, the supply chain, and so on and so forth. A wealth manager is very similar, but a wealth manager could also be your individual guy in a city who's managing money for a bunch of relatives and friends, and on a reference model is being able to get more clients for himself and slowly institutionalize, but not associated with a institute per se, but seemingly doing well for themselves on their own. So this is the thin difference between the two words, the two terms.
And what about a portfolio management service?
Okay, so portfolio management service in the Indian context is a subset of an asset management company. So an AMC is the superset. An AMC, if it has a mutual fund license in India, can have mutual funds under it. And mutual funds can be 500 different schemes of different objectives. A portfolio management service is a subset where a fund manager is appointed, right? A fund manager is appointed to manage X amount of money for you. The AMC is the superset, right? Under which you have mutual funds and PMSs and AIFs and all sorts, right? So a PMS is primarily you select a fund manager whose style you like, or a bunch of fund managers who are stylistically different, right? And you give them the right to operate a portfolio which is held in your name on your behalf. So the stocks are bought on your name, right? But the selection criteria solely and only lies with the fund management team.
Sorry, so if I had to just break down the difference between like a PMS and a private banker, like say for example if I had to invest with you, you and I would sit together and be like, hey, this is the kind of investment philosophy I have. We tailor something which is based on what I would like and things like that. Whereas for a PMS or someone like a fund manager who I'm investing in, who's running a PMS, I am basing my ideas on what his current or her current ideas may be. And I'm saying that I like the way you invest, so I am giving you the money to invest on my behalf.
Broadly, yes. So the way to look at it is that it is my job to sit down with you and objectively identify how much of what and how much of who we want to let manage our surplus, right? So I'm your selection committee, so to speak, right? And the investor and myself sit down together and weed out what we don't want, and then figure out the styles we need to attain our objective of institutionalizing the surplus money. Once we identify what we need and how we need to invest, after that the allocation is done to XYZ fund manager, depending on the styles.
Karan, how do you make money?
There are two ways to make money in private banking. The one way is that it's a pure distribution setup, right? Where we have our stake in the overall cost of managing the funds. The other way is a pure advisory model where we manage at AUM level, assets under management of that particular family, and we charge a fixed fee or a fixed fee plus a variable on the back of performance with a hurdle rate in mind on what's pre-discussed, so that you cross a certain amount of return, you can take a chunk of the excess return, right? So there are multiple models as to how private bank can make money. But broadly, these are the 2-3 variants, right? So as I said earlier, it's the fund manager's job to figure out the upside. It's my job to limit the downside to the best of our ability, basis our understanding of. So for example, the fund manager running the fund will not have an idea or an iota of inkling about what the investor's objective is for investing in the fund. They are running a fund at a micro level. So it is my job then to create an environment where X amount of the overall capital goes to Y fund manager for Z outcome.
So Karan, let's say I come to you today and I'm like, hey Karan, I'd like to invest with you. How would the process be?
The first question is, why are you investing?
Okay.
Right. So today, if you have a smashing business which requires capital, right, why not just put it back there? So then the way out, the good answer to that would be, I want to diversify. So a large chunk of my investor base are people who are diversifying from their core businesses, right? Where the return requirement could be lower than what they're earning in the business, which is fine. But what it does is it creates a rainy day haven, so to speak, for them, right? Yeah. So you build out a separate book in a diversified basket where, say for whatever reason, say COVID hits you hard, right? Or Russia, Ukraine probably hit people a lot harder than COVID did, because input costs went through the roof. And for most good companies, input is a raw material. So that's on your cost side of this thing, right? So those things, I think these 3-4 impactful events over the last 5-6 years have accelerated the pace to a large extent on creating a family office or creating a book that is outside of your core business. I think it started with demonetization, then GST came into play, then COVID came into play, then Russia, Ukraine came into play. So you had like 4 or 5 life-changing experiences in a short 6-year, 7-year span. So naturally, you start realizing that everything I touch is not going to turn to gold. So it's time to figure out silver and bronze and platinum as well. And which is why we exist.
Karan, Vishrut came to you. He invested a bunch of money with you. Okay. Now you are handling that money for Vishrut. A year goes by and something bad happened, and you lost a ton of that money for him. Let's say you did manage risk well and everything, and a completely asynchronous event which was not built into your risk happened, and that money sank. Vishrut comes to you all angry and he starts, yapping out, and he's shouting and he doesn't know what to do. How do you handle such a conversation?
Straight off the bat, I think you should never be in that position to begin with. I think our main objective is to never have that situation arise to begin with, right? So if you speak to my clients, some of my closer clients, they'll also tell you, maybe not in front of me, hey, that I'm a lot more defensive than they are, right? By nature. I might be very different with the way I manage my own money, but I'm very different when I'm managing outside capital, right? Because what happens is that, so we always create a basket which is contingent, right? Your contingent fund has to be there. So the short answer to your question is that a situation will not arise. We will not let that happen. Let's put it that way. Like, for example, a situation like COVID hits, right? When a situation like COVID hits, you know very quickly that it's not here to stay. Very quickly, right? And markets start discounting that a lot quicker. So the relief comes a lot quicker than you're ready for it, right? A lot quicker than the vaccine was the market rally. That started in April 2020. Right? Lockdown on 23rd March 2020 in India. Market started rallying April, or rather March 28th, 2020. So when mismatch occurs to that extent, if you knew why you got in the first place, right, and you had your contingent fund ready, then you're going to triple down because your objective is very clear. Something has gone below weight. When I do the risk review in that quarter end, March quarter end, largely you would have gone below weight for a whole bunch of things. You would have breached a lot of barriers on the low side. And that framework tells me that the question to ask is that, are we actually in a situation where we cannot see anything, where we can't see the light at the end of the tunnel? I think the sun came and blasted through the bedroom window in a week from lockdown, right? I don't think it took a lot longer than that. So impactfully speaking, from a pure investor point of view, I'm not going to the social cultural side of things. Of course, there was a lot of damage and this is a pure capitalist side of things. We're not going down that path. And just putting the disclaimer out there before I get, people chasing me in my house. So, of course, it was one of the worst things.
We're not big enough for you to get people chasing you through your house.
It takes one person to see it and spread. So, it's all it is, right? So all I'm saying is that, this is purely from a market investor, capitalistic mindset point of view. So I think very quickly people realize that this isn't as bad as it seems. On the contrary, it's just speeding up the shift from unorganized to organized a lot quicker than. So the school ka bacha who used to come first in class 3-4, who you were betting on, is now going to come first with a bigger margin. Right? He used to get 99. The other guy would get 97. Now the other guy is going to get 87. So there's going to be a little more pitai in the house. Right? But the margin is just going to get wider. And is that some more Farah story? You're just going to run a lot quicker in that short period. And, the distance is just going to increase even more. So there'll be a Sahara desert between you and the next guy. And which is pretty much what happened, right? Today when I say HDFC is 9% of India's PAT, the top 20 companies of India account for 85% of India's PAT. Before COVID, this 2 years before that it was 65%. 10 years ago it was 35%. So see how rapidly that, it's shrinking. And it's all RBI and, MCA data. It's not rocket science. You can just put it off the Ministry of Corporate Affairs website. How many companies are going out of business is not even a joke.
So, Karn, how do you manage expectations?
That's all I do, actually. That's my only job. That's my basically, if I could, my visiting card should be it should literally say whatever manager of expectations.
Like you had a period before COVID where things were, stable-ish. Then you had COVID hit, everything just went skyrocketing down. And then after COVID, we've seen like this market which has gone into like a bull run and, things are going great. And 2020, 21 has been, superb. Startups are getting funded. Everything is like, there's money flowing in from everywhere. Then there's 2022, there's a reality check. And like 2023 is sort of consolidated on that and we've gone from there. So as you said, that people who are getting into investing nowadays think that everything they touch is going to turn into gold. Everywhere they see, everyone's making money. The market is touching new highs all on a weekly basis, it seems. So how do you, when someone comes to you and they're like, oh, I'm not happy with this, or this is not happening, or these are not the kinds of returns I expected, or why am I not making as much return as my friend is, etc., etc. How do you manage expectations, number one? And number two, how do you deal with people who may not be the most educated about finance and they've come to you because you have that knowledge, and how do you transfer that knowledge to them in a way that they can understand it as well?
Yeah, so you've kind of touched upon 90% of my job, right? So I think the main thing on managing expectations is going back to my point on being able to set the expectations straight off the bat to begin with, right? So again, I go back to framework. So I started by saying my job is to institutionalize the way wealth is managed. If you institutionalize the way wealth is managed, then you're setting the expectation in the IPS or the framework that you're setting out, right? So you actually have a document which tells you what the objective for investing was 2 years or 3 years before COVID and 2 years and 3 years after COVID, right? At which point, when COVID does hit and you throw your portfolio into the IPS and you see that because of what the market is doing, you've gone underweight. So I keep saying that averaging out, or rather increasing your weight, re-entering or adding, or rather in our language we call it topping up, should not be a function of subjectivity. It should be very objectively driven. So for example, you have to quantify it. Why am I going? So for example, if say Nestle went through the roof during COVID because kids were having milk regardless. COVID, no COVID, दूध तो बिक ही रहा था, right? What got hammered in the process was your financials. Like Bajaj Finance got smashed, right? Now the question you have to ask yourself is, or rather the ecosystem is that Bajaj Finance is down 2/3. And you go to the ecosystem. Now you have to go to the raw material supplier of a Bajaj Finance. Who's the raw material supplier for Bajaj Finance? An HDFC bank or a Kotak, who's basically lending to Bajaj Finance for Bajaj Finance to further lend out. We touched upon liability and asset, right? So the liability side of Bajaj's books is largely the AAA rated banks. So they borrow at the lowest rate possible, right? And they're doing consumer lending on top of that. So the question you go and ask to the raw material supplier Bajaj Finance is, what is Bajaj up to now? Stock is more than halved, right? Are they still borrowing from you? So the feedback at that point is, not only are they borrowing, they're borrowing more than they were before. Because what has happened in the process is that player number 3, 4 was borrowing at such a high cost through that period. When the wind changed, when headwind came crashing on, they became Titanic. They crashed and burned. There was no two ways about it. Now that market share, that consumption, that extra demand that exists through that period, that demand is still there, right? People are still buying things online, right? Who won that market share? Bajaj was borrowing more from these guys because people were coming to them saying, hey, I'm looking to buy stuff online. I'm stuck at home. I need a bigger TV now, right? I need a better fridge. I need more connections. I need a better laptop. I need a nicer phone. Now everything is going to happen on Zoom for the rest of my life. It's all work from home. I'll be sitting with a suit and underwear at the bottom. And that's how I'm going to be dealing with people for the rest of my life, right? So in that process, you need a better phone. You're going to upgrade. That's your capex, your individual capex, the capital expenditure, right? Who's going to finance that? Player number 3, 4 are out. They don't have the ability to raise money. So when you realize that Bajaj is actually borrowing more, Bajaj can only be borrowing more if there is demand. And Bajaj has pricing power and is gaining market share in the process. So the only two ways to identify good companies is premium pricing power and the ability to gain market share. That's exactly what they were doing in the process through that period. So while people panicked, right, our weight came significantly below what it should have been for a company like Bajaj Finance or a fund manager that manages a portfolio stock like Bajaj. His job was to then identify that company and say that, hey, it's not only the same, it's actually better. So why don't we increase the weight from what it was before? If it was 8%, why don't we make it 12 now? So whoever had the ability to quantify that, because the framework was ready beforehand, whoever had the ability to quantify that was able to take full advantage of that journey up. It's 4x since, right? Stock is up 4x since. 1800 bottom, 7500 now. More than 4x, right? And now that HDFC Bank is merged with HDFC Limited, there's a 1.5 lakh crore gap in the market. Because HDFC Limited was an NBFC, that 1.5 lakh crore NBFC market share, that's up for grabs. Who do you think is going to get the bulk of it? So, opportunity size, product premiumization, price premiumization, and ability to capture market share with distribution, network, and data. I mean, it checks all boxes. It's a very volatile stock, by the way. If you see its absolute return in the last 10 years per financial year, not on a CAGR basis, you'll realize that it's a very difficult company to own and hold on to. Right? It'll show you the depths of hell and the heights of heaven. So that's where we come in.
Let's have a fun activity. Let's have you anti-sell me equity.
Hard for me to do that.
Convince me, never get into the stock market.
See, so you have doomsday soothsayers out there, right? Always. So if I take a leaf out of a doomsday soothsayer's book and just be, it's very easy to be pessimistic and sound smart, right? Because I think who said it? Nietzsche said that everyone is just waiting to die, right? Everyone's just waiting for the day to die, doomsday, Armageddon, right? So it's very easy to sell pessimism. So to create panic, I can be like, look at what China's up to. Right now, it's an economic superpower. They're spending hundreds of billions of dollars on defense. Right now, they're not a defense superpower. They're an economic superpower. Today, if the Quad shuts down the South China Sea, they're in a soup. 5 years down the line, they may not be in a soup. Right? So, look at what China now. India is getting a lot more attention from the rest of the world, and the superpowers and the young countries are all looking up to India to be the sole light provider to the entire globe. How do you think China is going to take it? Are they going to get replaced easily? Are they not going to create havoc in this situation? COVID plus minus, different variants of new pandemics will be sent as pure bio-war. So, from a pessimistic point of view, there is a lot of risk ahead. And there are a lot of bubbles that could be burst in the process. And I think the position that India is trying to get to from number 5 to number 3. Now, I think Goldman came out with a report saying that we'll be number 2 in 2075, where they show US is number 3. So China is number 1 in that report. So I think from a risk point of view, I think geopolitically, while we're strongly placed, the reaction to our position today and where we're trending may not be a smooth ride. So if you want to kind of stay safe and stay out of it, fixed income keep fixed income assets might keep increasing rates and safety in that regard. So like for US, I feel like the rates are going to remain sustainably high for the foreseeable future. How much ever you say consumption, hey, I would like to be surprised on the upside, but I feel like rates will remain sustainably high for $30 trillion of debt. You're about to breach 1 trillion of interest payment on that debt. US, if I'm not mistaken, correct me if I'm wrong, I've not done any research on this, but 4 trillion is what is generated from income taxpayers in the US. If 25% of that money goes into paying interest, if that was a company paying 20% of its total revenues as interest cost, I don't think I'd be investing in it, right? So someone's got to give at some point. And there could be a geopolitical blow up, especially with the race towards, looking at what's happening in the microchip industry with TSMC, especially Taiwan controlling the ecosystem. So that is a big risk. There's no doubt about it. Because, geopolitically, it could play havoc for a country like India or for that matter, the globe. We've seen 10, 20, 30 years of no action in the past. So, aisa nahi ki it may not happen again. It could happen again. So, if you want to live a peaceful life and you're happy with Biaj, interest, and you want to golf it up and just go to office, chill, have your cup of tea in the morning, meet your friends for lunch, play cards in the evening, have a few drinks, have useless conversations.
Basically live the life that most people in Calcutta are living. Hot take.
I think that's changing rapidly. And you know what's happening? I feel like because there are a certain segment of our generation doing well in their investing journey, or rather creating the investing framework correctly, right? That is not sitting down very well on the guys who weren't doing a lot earlier, who had a head start. So the corrective measures, it might come with higher mortality, higher risk, higher incidence, because it's a ego play at the end of the day. But it's a good shift. It'll be a steep learning curve, but it's a good shift. And I'm seeing that more and more, Just take sports as an example, no? I think the greatest economic indicator of a country is how it's doing across the board sports-wise. Forget GDP and per capita and all that. Per capita, of course, great. If you take the first 10% out, you've got nothing.
Karan, how much money are you managing currently?
Unfortunately, I can't disclose that. But as a firm, we're managing 12,000 crores. We've been in India for about 3.5 years now.
Awesome, Karan. I think we have come full circle in our conversation. We started with pricing power control and things like that, and we've come back to that and we've had a whole conversation there. So I think just to wrap up, what would be your one line about India's future in terms of equity markets?
I think India's future, the result will be the markets. Let's touch upon India's future itself, right? So, equity markets is a result. While it is forward-looking, it's capturing the result before time.